Is TXN stock a sinking ship, or is this the ultimate discount before a massive rally? Texas Instruments is flashing heavy sell signals right now, and the short-term trend looks incredibly weak. Yet, a handful of contrarian analysts are pounding the table, insisting the stock is completely undervalued. Who is right and who is getting trapped? Let's look at the facts. Texas Instruments, trading under the ticker TXN, is a global powerhouse. They design and manufacture semiconductors, specializing in analog chips and embedded processors. These aren't the flashy AI chips you hear about every day, but they are the literal backbone of the global economy. They power everything from your car's braking system to massive industrial factories and medical equipment. But right now, the stock is under intense scrutiny. Why? Because the broader semiconductor sector has been highly volatile and industrial demand has taken a serious hit. Before we dive deep into the charts, do me a huge favor. Smash that like button, subscribe to the channel right now, and leave a comment below. Seriously, drop a comment with your prediction. Is TXN a buy or a trap? Let me know and let's get into the data. If you look at the technical analysis, the picture gets complicated. The current price action shows a clear grinding downward trend over the medium term. Momentum indicators like the relative strength index are hovering near oversold territory, reflecting deep short-term weakness. Every single time the stock tries to rally, it gets rejected at key resistance levels. Volume on the down days is higher than on the up days, which shows institutional distribution. Sellers are firmly in control right now. However, we are rapidly approaching a massive multi-year support zone. If that support holds, it could form a powerful double bottom. If it breaks, the floor opens up and we could see a rapid acceleration to the downside. This technical weakness is exactly why Wall Street is deeply divided. If you look at the recent consensus ratings and signals, analyst sentiment has turned distinctly bearish. We are seeing a wave of downgrades to sell and strong sell. Investment firms are citing prolonged inventory corrections and margin pressures as reasons to stay away. The short-term outlook looks bleak, with multiple negative signals flashing across quantitative trading models. This brings us to the ultimate debate. Is TXN genuinely undervalued, or is it a classic value trap? The bulls look at the company's massive free cash flow, its history of dividend growth, and its unmatched manufacturing scale. They argue that this downturn is purely cyclical. They believe the market is giving you a rare gift to buy a premium company at a steep discount. The bears, on the other hand, scream value trap. They point out that competition in the analog chip space is intensifying, and if the global economy slows down further, TXN's earnings will continue to erode. They believe buying here is catching a falling knife. The downside risks are incredibly real. The semiconductor industry is notorious for its brutal inventory cycles. If Texas Instruments overproduces while demand stalls, prices collapse and margins get crushed. This volatility is exactly why retail traders often get trapped. Retail buyers see a famous stock dropping, think it's cheap, and buy too early. They don't realize that institutions can keep pushing a stock down for months until the macro environment actually shifts. Let's break down the absolute best and worst case scenarios. The bull case relies on a sharp macroeconomic recovery. If industrial automation and automotive chip demand rebound faster than expected, TXN will clear its inventory rapidly. Combined with their new, highly efficient manufacturing plants coming online, earnings would skyrocket, sparking a massive short squeeze and a violent recovery back to old highs. Conversely, the bear case is a prolonged global slowdown. If high interest rates keep crushing industrial capital expenditure, TXN's revenue will contract quarter after quarter. This would force analysts to cut earnings estimates even further, causing a vicious continuation lower that could wipe out years of stock gains. Looking at the outlook, you have to separate the short term from the long term. In the short term, expect choppy, painful price action. The negative momentum and analyst downgrades will likely keep a heavy lid on the stock for the next few quarters. But if you look at the long-term horizon, 3 to 5 years out, the secular trends of electrification, smart factories, and green energy haven't changed. Texas Instruments will still be a dominant player when the dust settles. So, what is the play here? Are we looking at a temporary cyclical bottom that will mint new millionaires? Or is this the beginning of a fundamental breakdown that will trap anyone brave enough to buy the dip? The charts are screaming one thing, but the fundamentals are hinting at another, leaving the entire market guessing what happens next.